Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 18th, 2020. It's 11:11 a.m. Eastern Time, so the market's been trading a little over an hour and a half now. So let's just take a look at the charts. What we'll do is start out with the broad markets. I like to do that, just an update there. Not really much has changed. We're back to the top of those multi-week, nearly multi-month trading ranges now. And I'll roll into an update on gold and silver, some more follow-up on the cannabis stocks. Started highlighting those last week. Touch on agriculture commodities. And time permitting, I'll get to bonds. I'd like to look at, show you guys some levels to watch on certain bonds such as treasuries, LQD, JNK, the junk bonds, plus investment grade quality bonds. So let's start out with the broad market now. Same old, same old. We're back to that 200-day. We've been testing the 200-day moving average now for weeks. That's this red line here, the 200-day exponential moving average. Had a test and a failure there. A couple more tests here, and we're testing it once again. We also have, that there's a line there because that defines the top of this multi-week trading range. It goes back to early April, so we're almost 2 months into it, but well over a month. And that is here. If I box it in, it looks like this, and that's it. It's, that's a market going nowhere. We started out with almost a V-type recovery, almost a V-type bottom, not exactly, and then kind of just moved sideways since then. So while the market's not going down, it's not going up either. I'd put decent odds we'd come back again for another test of the 200-day. It is actually more than common. So in other words, not only is it not uncommon, it's more than common to see a pop above a level like that. These key, and I've gone back to previous bull bear markets. You can see the 200-day when you come up and test it from below, just like we did back here after that initial leg down. It's not uncommon to see a couple pops above there. In fact, again, it is more than common. So I would put the odds at this point, even though we're right back to where we were last week and the week before, I would put the odds at probably 60-70%. Definitely better than coin toss odds, a little bit better, that will pop it. But I think that pop will be very minimal. I've maintained for the last month or more now the same thing. In fact, we had, just late last week, legendary, money manager Stanley Druckenmiller. He's, one of the greatest, currently active hedge fund managers out there. Tremendous track record. He said what I've been saying for a month and a half, that the risk reward on this market, well, his words were the worst that he may have seen his entire career. The guy's older than me. I say that the worst risk reward ratio that I ever recall was back in late 1999, early 2000 with the dot-com bubble. We had valuations insanely excessive. But again, whether this beats that or not, that's moot. This is either the worst or the second worst risk reward ratio that we've probably seen in it's easily decades, if not generations. So and I'm talking fundamentally. I believe, I didn't listen to Druckenmiller's interview, just read the headlines. I believe he's referring to fundamental, but I can make a case both fundamentally and technically. Fundamentally, we had the stock market first fell off a cliff long before any of the earnings or economic indicators were even out that have started to only reflect the initial impact of COVID. Remember, everything's dated. Earnings are reporting the last 3 months of a company's quarter, profitability, earnings, and losses. And then they're a month delayed before they even come out. So you're talking data that's up to 4 months old. Same thing with a lot of the economic reports, such as GDP. And things like that. So what happened is the economy fell off a cliff, and you've had a near V, not exactly a V, but a near V recovery until we started moving sideways here recently. And meanwhile, and again, this plays into the fundamental part, we've seen the sharpest deceleration and pretty much just all economic indicators falling off a cliff, unemployment, consumer spending, and everything else. So this is the dichotomy, and I've never seen again anything like it in my life. Even the dot-com bubble built over time. Never in such short order have I seen such a stark dichotomy between fundamentals and what the stock market's doing. And again, and Druckenmiller talked about this. He thinks it's a mistake that people are on the side of the Fed just because the Fed had their markets back. I have no doubt that's what most, if not all, of this is. And he, like I will acknowledge that, the big unknown, the big wild card is how much more aggressive is the Fed going to get? How many more how much more asset purchases are they going to do, things like that. But with that being said, I just want to talk about, again, risk reward. And what risk reward means is, okay, so if you buy stocks here today, what is your reward potential? How much upside is likely versus how much downside is likely? That's what risk reward is all about. Every skilled or experienced investor or even active traders always factor in risk reward to a trade. It is one of probably the most important things to look at. So I maintain from a technical perspective, I can see very significant resistance just overhead at about 302.50. And also remember, we've been testing the 200-day exponential moving average recently, and you have the 200-day simple just above it. A lot of traders look at the simple. 302.50 is less than 2.5%, or about 2.5% from where we are now. What is 302.50? Well, it's a couple things. It was a major high back here in 2019 last year, where the S&P had tried on several attempts to get through it, followed by a correction each time. We had a divergent high each time as well. Might not be able to make it out here. If I expand this PPO, you can see at that point in time, prices were making higher highs, and the PPO and the RSI were both making lower highs. That was our divergent high 1. We had a correction, divergent high 2, we had another correction, and then the last time we had a divergent high was right here before the market fell off a cliff, dropped 36%, and then right here. These are the current divergences, and there's plenty of room for them to, extend, and that's what I wanted to talk about. So it kind of meshes in with that whole, the fundamental risk reward is not favorable technically as well. Because you still have significant overhead resistance in the stock market, whether or not they pop the 200-day. Like I talked about before, I like to use it exponential, but I also keep a simple moving average 200-day on my chart, because some traders, that's all they look at, and so they may sell when we get there. That 302.50 was a big level before in the past. Finally, we finally broke out, and that led to a strong advance. And then on the way back down, we were free falling. Remember, this was a waterfall sell-off, and we had what I call momentum fueled overshoot of that 302.50 and both the 200-day simple and exponential. Markets came back up, tested them, briefly recovered all of them, and then boom, fell. So again, that's what I'd put, decent odds that we pop this, whether we go all the way up there, overshoot it a hair or not. That is my most current, most optimistic scenario, and favored. I'd give it slightly better than coin toss odds, but again, not enough to chase. Why risk trying to make 2% on your money to risk a sudden reversal, big gap down? This has been one thing about it is volatility is starting to expand, even though we haven't really gone down. Some people always equate the expanding volatility with the market falling. Well, it goes both ways. We had some of the biggest down days here recently, and some of the biggest up days today, like today. And that's, we have now expanded volatility, and it can go the other way just as fast. And with gaps, you can't sidestep that. You can trade futures, get stopped out overnight, especially now that the weekend's over. You have ESNQ, but those are going to trade around the clock, so you could be stopped out at 3 in the morning. But if you're trading SPY or QQQ, that's not the case. You're going to be subject to whatever the market does on a big gap. Okay, I've already talked about the stock market more than I wanted to, and I always lead with that because that's what that's kind of the tide, of where things are going. But there are many other sectors or individual commodities that have nothing to do with the stock market. In some cases, sometimes they work inversely, they move inversely, and sometimes they just do their own thing regardless of what the stock market's doing. So we'll get to some of those in a second. I'm going to touch on that again: gold, silver, cannabis stocks, commodities, and treasury bonds. So that's it, bigger picture. There it is. You have about 2.5% upside. If that were to happen, again, it won't change anything technically other than a break above the recent highs. That's, the 200-day. I should acknowledge that's a near-term bullish event as long as it holds. If it proves to be a false breakout, then that's not bullish. But as far as these divergence lines go, there's plenty of room to lift those up a little bit and see one more thrust up here, followed by a reversal. And again, that would just keep these divergences intact like that, and just put in higher highs on the stock prices with lower highs on the indicators, just like we had back there that last time we had a divergent high right here and dropped 36%. And one of the things that makes me suspect that we'll probably pop that 200-day and maybe run up a little more is, we had the makings of a near-term downtrend in play right here. We had a series of lower highs, and so far now we're testing. We're up to, we haven't taken it out yet. Again, maybe, if we're talking a point or two on a 3,000 point index, no, you got to need to take it out impulsively. But that would call in this near-term downtrend. We only had two lows right there, or one, major reaction low and then a lower low. And again, you had a couple reaction highs. Now that's been taken out. We're right at that other one. And so again, this kind of, definitely calls that very near-term downtrend into question. But again, let's not forget, this is a 1 month chart, 60-minute candlesticks of the S&P 500 futures. Zoom it out to 3 months, and again, just like SPY, the bigger picture is this multi-month sideways trading range. So, again, you have these little, within the larger sideways trading range, you have these little near-term uptrends, near-term downtrends, uptrends, downtrends, uptrend, downtrends. And so far, this was a downtrend, and now it's being called into question. Okay, with the stock market spinning its wheels, going nowhere but sideways for nearly 2 months now, again, that's not where the opportunities to make money. The active trading, yeah, you can in and out of the futures, catch a 2, 3, 4% move over a day or two. Short the top of the range, sell your longs there, and then cover at the bottom. You can do that kind of stuff, although it's been somewhat of a sloppy range. The bottom's not as well defined, and we only have a few reactions on the top. But where there's money to be made are the other things out there, and gold, is one of them. This goes back just a few weeks ago. We had that beautiful little triangle pattern right there. A pulsive breakout, all this highlighted again at the time, then a back test with the next objective entry and a nice run up in gold. So what I posted, this chart was posted this morning, but I did follow up in the comments section below. I always encourage you to go into the site. I mentioned here's a level that I didn't have in the chart this morning, 1736, we'll call it, rounded off, and that's the first target where reaction's likely. In fact, that's my minimum target. That may be it for gold. I told you I shorted it, and it was a short last week, and I covered that right here. I'm going to wait and see what happens, because that could be it. I may jump back in depending on what happens, but this is my minimum target right here. It's pretty decent support. That's why I wanted to add that. And again, I followed up on it right after that post with this level here. Look, and if we break it, well, these are the same. These are still the targets, but at best I see us coming back down to this trend line here. That goes to the left of the chart. Here, let me get back to the current chart. That's the one I posted. We can go back, let's go back 2 months and show you that. Here's that trend line right there. So that is, again, the range, and how far gold drops will likely depend on where the market goes. So, what you're seeing today is gold tends to be a risk-off asset. When the stock market is correcting, people tend to buy gold. And when it rallies like today, everyone's getting giddy over this new, the latest hype, on a vaccine for coronavirus. Ridiculous, in my opinion. Stage 1 clinical trials. We'll see where it goes. It also, we know it's a matter of time before they come up. As I've been saying, coronavirus sooner or later will be a non-event. There'll be a vaccine. People will take precautions. Whether we get another flare-up or not is yet to be seen. But to suspect that we wouldn't eventually get a vaccine or anything else, basically saying that's the end of the human race. We're going to get rid of this, or at least control the virus as we have every other virus in the past. So, with the market rallying again, it's a bit of a hopium rally at this point, in my opinion. Misplaced, in other words, because there's, the economy is still falling off a cliff regardless. But this is that price channel in gold right here I showed you. And so I zoomed out a little farther with that 1736, about where we're flirting with now. You can see it's a real good level right there. That's why I added that to that chart. Those are those other levels. And I think, at most, if the stock market continues to rally, would come down here, and this would be on or around here. 1691 is just below. But I like that trend line as a max pullback target. So that was it. We overshot that 1759 target. There was the breakout of the triangle right here. So this was our first long entry. Next objective entry was pointed here. We went up in this channel and we broke it. So we broke support today, and that put gold on a sell signal. Again, there was a divergence everything last week. So I just wanted to say we're at the minimum pullback target that I was expecting, and there could certainly be more, but unless that goes, unless the market goes a lot higher, I think that the downside to gold is very limited at this point right now. All right, silver, same thing. I did an update on the home page today. Let me just pull the chart there. Since I did that update, I told you guys that we had this uptrend line that would trigger a sell signal. This was posted silver back here originally a few weeks ago on a breakout here at this point in time, and I also said that I suspected silver would outperform gold. So you had a breakout back test, about a 20% rally from that back test to this recent high right here, and that was the uppermost target I had back at the time, 1773. We'll call it 1774 rounded off, and you can see that we put in a small little divergent high here. We were at resistance last week where we could have reversed, but what happened is we have this trend line that we continue to work our way up, but it broke today. Actually, since I posted it earlier, we were above trend. We were right here, and from there we went on to break that 1773 level and the trend line with an impulsive drop back to the first target. Now, again, the first target would just be the price targets on the upside in reverse because they were resistance levels on the way up, and now they should and so far have acted as support. So again, just like gold, this may be the end of the run for silver, and I'm covering these futures charts because it's more of a pure read on the metals. Yes, I know a lot of you don't trade futures, so here's my SLV daily chart. It's kind of smack between, it's in what I call technical no man's land. That means between support, which is 1552. It was resistance. We gapped above it today. And your next resistance, and it's a pretty good one, is right there at 1663. So here we are, kind of in no man's land. And, overall, this was also highlighted back then. There was a breakout of that triangle pattern in SIL, which is a silver ETF. And big move there. That's about 13%, not as much on the futures. Again, maybe we were in earlier on the futures on that breakout. But bottom line, where do I think it goes from here? I wouldn't chase it at this point. Like I said, we had some sell signals today. To be clear, you can, if anything, you should be short right now and/or covering if you did already. I want to see the dust settle on silver and gold before I, look for any new re-entries. Gold still has that potential divergent high. Remember, we had a small divergent high here. There's still the potential that gold, it actually has divergence right now. So we need to watch this. I'm going to put another trend line right here. Let's just say right now, near-term neutral. I was, bearish last week heading into, was it Friday in the video? And then again this morning, clear, we got those sell signals, but now we've hit the minimum targets. The bigger picture is gold's in a bull market. Normally I might look for much more, and we could get some more. And I'm going to show you, that's what I'm doing here. I'm showing you levels, where to, what should contain any other pullback, any other downside in gold. About 158 is pretty good support on GLD right there. Where's our official trade? Right here. So our official trade is this. We've been in this one for a while, and it's still a long trade. We still have the next target all the way up here at 172.55. Whether we get there soon or not will depend on whether or not these potential divergences end up manifest in the form of a correction or not. Delete that. Okay, cannabis, definitely seeing movement in the sector. It started with, as I covered in last week's video, somebody asked me about CGC, I think it was, one of the cannabis stocks. I said, look, I don't have a very strong read on the chart. They're going to report in June, coming up in a few weeks, but the one I liked was ACB, who reported last week. They were set up right before they reported in this bullish falling wedge pattern with a later that day they end up putting in a bullish engulfing candlestick, and then boom, 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 up another 61% today. So from there, before they reported, you're talking about a 200% run in this stock. Already hit and took out my first two targets. We're still going, and what this is momentum in the sector. And as I often say, never, ever, ever underestimate just how overbought or oversold these pot stocks can get, because when they want to run, they can really run. And I can add levels all day long here. All I can tell you is right now there's momentum in the sector. ACB kind of kicked off the rally here with their, well, whatever they said in earnings. I didn't look, doesn't matter. They could have reported the most abysmal quarter and outlook possible, or they could have blown the cover off the ball. It doesn't matter because they were technically it was set up bullish. Just like we had bearish, divergence here at the high, negative divergence at that high over here. I don't know why some of these lines just sometimes seem to disappear, but you can see, these divergent highs, divergent lows. Again, they sometimes disappear. Wash, rinse, repeat. These are major trends. That divergent low was good for a 138% rally. This divergent high was good for a 63% drop. Even this little divergent low along the way here, I don't know, again, some of these trend lines disappear. It was marked at the time. That was good for 60% counter trend rally in a bear market. But this one looks like so far the real deal. At least it's put the momentum in the sector. And as I said, I already went over some of the favorites last week. I told you this one, low price, high risk, but I talked about risk return go hand in hand. And so what does that mean? Well, you have a higher risk on a low price penny stock, but your return potential is also a lot higher. This sucker's up 50% today. It broke out. There's that same triangle I showed you on Friday, I think it was, or Thursday, and it didn't gap and leave you, where you couldn't jump in and get it. Like, ACB had a big gap after earnings, so if you really weren't in it, then it's hard to chase. But this one, here's where we closed Friday right here, and we broke out today, and we just have the stock has continued to run. So that was a catchable, if you will, breakout there. It didn't gap up 50%, in other words. And there's where a likely reaction is. You have a few candles there. I'll put it's minor resistance, but again, this one could run all the way up here without even blinking. No problem, run up to that 49 level at minimum. Again, that was my minimum target from last week, and that's still another 64%. And that's, look, birds of a feather flock together. These are very much momentum stocks. When the momentum traders come in, when they see downside momentum, the shorts pile in. When they see upside momentum, the longs pile in. And again, I already went over a lot of those last week. Hexo breaking out, Kronos Group, and MJ, again, like I said, MJ is the ETF. Tilray hasn't even broken out yet. You have this trend line, so that one hasn't gone yet. Close. OGI has now broken out today, took out the trend line and that 151 level, so there's an objective long entry right here, and so forth and so on. CGC, like I said, coming up. But then, the simple way, what I like to do, and I've shared this for years now, going back to 2015, 2016, I think it was when we first started trading a lot of these before they were on anybody's radar. I say I like to take a shotgun approach, sprinkle little bits of cash in several of the names with the best looking charts, overweight those that have a higher market cap like ACB and CGC and TLRY. Those are more established companies, less risk, so where you might put whatever your number is. If you want $20,000 in the pot stocks, break it down into, let's say, half a dozen names or a dozen names. You're going to put maybe 3, 4, 5,000 into the ACBs and TLRYs of the world, and whereas you may only put $1,000 into something small like that. What's that other one that popped today? The green organic Dutchman. TGODF. This one you don't put. If your 20,000 is your number that you're committing to the sector, you might have $500,000 portfolio, 100,000 doesn't matter. But again, never put all your money in the pot stocks. But that's it. You take much smaller position sizes here because remember, risk reward cuts both ways. If this stock opened up, with a bankruptcy filing and it was gapped way down, and you've put $1,000 and it's only half of 1% of your overall portfolio, then you're not going to be burned too bad. Likewise, you might say, is it even worth putting $1,000? Well, on that, and again, I'm just picking a round number. You could put more or less. Well, you made $500 today on $1,000, and if it goes up another, heads to that other target, you'd be up 146%. So you would have made, $1,400 on your $1,000 investment. No, that's 100, actually about 150%. So yeah, you would have made $1,500 on a $1,000 investment if it gets there. Okay, and the other option, if you don't have the time, inclination, or enough assets to diversify properly among various cannabis stocks or any sector you're trading for that matter, choose the ETF. It's simple, safe. You're not going to make 50% in a day like you can on some individual stocks, but you're also not going to lose 50% in a single day on a bad gap down against you. So that's where it cuts both ways because you are diversified. All your eggs are not in one basket. This ETF is doing that job of diversifying among the different names for you. And like most ETFs, they'll typically put a higher weighting on the larger companies, and then less on the smaller companies. But that's it. We broke above the downtrend line today. That's buy signal number 1. We gapped above. We also took out the 1268 resistance level. That's buy signal number 2. There's your targets. I think at least if we can get some traction here, well, let's just say next target and then 1573, then the downtrend line. So let me just say this for right now. Minimum target, maximum target, downtrend line right there. And a very likely target, almost let's say a preferred sweet spot right now. If there's momentum, what I like to do in these guys, just use wide stops and just let it run. Trail your stops up. It's going to be zigs and zags along the way. If it gets to 1573, that's pretty significant resistance. And who knows, maybe it zigzags its way there a little bit longer. Usually these guys move fast, but it's possible we could, consolidate around a while, go like this, move up, and eventually get to both 1573 and the downtrend line. And if so, that's double resistance or dual resistance, all the better, an objective area to take profits and then recycle back in on either a pullback or on a breakout, a solid break above the 1573 and downtrend line level. But again, only time will tell if this breakout even sticks. I mean, this thing could turn around and fail tomorrow. But right now there's momentum there, so that's an opportunity, and I'll continue to update these charts as long as that opportunity exists. And another area, again, more of an asset allocation play, diversification. Don't put all your eggs in one basket. Risk reward on the stock market sucks, despite the how resilient it's been lately, and that is to allocation or a small part of your portfolio into commodities. This is the one size fits all DBA agricultural ETF, has various ag commodities, everything from livestock to grains and cotton and things like that. So there's your downtrend line, bullish falling wedge pattern breakout and a back test. A little bit of work to be done. These ag commodities seem to want to look like they're going to get going, like they want to break out. We need to see this thing move up. What I want to see is this PPO right here, the signal line, the white line, get up above that 0 line and tell us that we're in a new trend. But these are still the targets for DBA. Of that, if you want to kind of narrow it down further, I'm a little more partial to the grains. JJG is the grain ETN, and it has corn, soybean, and wheat. You see a bullish falling wedge that it's yet to break out. And when we look at those individually, corn, bullish falling wedge broke out recently and still looks constructive. I'd like to see, we need to see a little more momentum coming into these. Again, constructive charts don't always mean that they're going to play out. What you want to see is the buyers start to come in. So, like I said, corn, you can do that. Soybeans, SOYB, that went wrong. There it is. Soybeans has yet to break out. So if and when this breaks out, you'll probably see JJG get going, maybe a little upside momentum, and the same with corn and wheat. So that's soybeans right there, still pending a breakout, SOYB, and then wheat is WEAT. This one is coming close to that stop right there. But again, I talked about wheat before. We've traded this one quite a bit in recent years. Bullish falling wedge breakout. And we've had these 3 lows to about this level. This was not a wedge, it was a price channel, and it broke out right here. Went on, to hit these targets, just like this one did. That was the last time we came down to that level. I believe it was highlighted at the time. So the buyers keep stepping in here at wheat. And I mentioned that this time that almost seems too obvious to me. So all eyes are probably looking for another move down there, waiting to buy. and there's some decent support here, and that's why I think that we'll probably reverse. But again, this all comes back to that. If you don't want to put all your money in wheat, but you do like some of the idea there, JJG. And if you don't want to have it all concentrated in the grains, which is corn, wheat, and soybeans, then DBA. And if you want to wait for more evidence that we've reversed, put a bottom in the ags, nothing wrong with that. I just again like spreading things around. I think the downside appears minimal on ag commodities right now, especially compared to what the downside potential in the stock market is. And then last but not least, let's just look at treasuries and bonds in general. This daily chart of TLT is getting, it's a little bit choppy. Here's a trend line that it is a valid trend line. There was a little spike here. Remember, treasury prices went wonky when this whole thing started. You had forced liquidations, just about all assets, even the defensive ones like gold and treasuries got sold down with the stock market due to forced liquidation of margin calls, everything I talked about, and risk reduction from pension funds and pension plans and things like that. And then boom, snap right back. So that was an overkill, if you will. They shouldn't have been selling off the risk-off assets like gold and treasuries as much, but everything got liquidated again due to forced selling, and then snap back. So I do think this trend line is significant. I have it also on the futures, which I'm going to get to here in a second. But so on if you're trading TLT, these are the levels to watch. Support levels it should hold, 162.57, and if they don't, then that's quite bearish. So a break there could bring us all the way back down to 152.62-ish, maybe even lower. 60-minute chart kind of paints a bigger, more clear picture, if you will. I know I have a lot of lines here, and let me just do this. Well, I'm not going to change this. I was going to take away these lines. But this, you see this? Does that look familiar? That's the stock market, because nobody knows where things are going right now. You have bulls and bears alike battling out selling. Markets stalled out. The stock market, so is treasuries. So treasuries, just like the stock market, are going up and down within this trading range. Best you can do is maybe trade it. Look for these little micro levels, like little trend lines here. There was an uptrend line that broke recently, and you can trade it that way. But again, the bigger picture is going to say whether we have a definitive and lasting break to the upside or downside. Now let me show you futures real quick for those of you that trade. Even if you don't trade futures, even if you only trade TLT or any of the other ETFs, IEF, SHY, those are the shorter term treasury bond ETFs. Let me find my ZB chart. ZB 30-year, well, not 30-year, but the long bond. These are bonds. I think their ranges are about 25 years, 22 to 25, 27. Ultra UB is the longest term. But there's that same trend line, very well defined here, actually better than TLT, because remember, TLT is an ETF. And so sometimes ETFs, especially in volatile markets, kind of unhook or decouple briefly from the actual security that it's trading. Futures tend to do a better job. But either way, you have a nice clean up trend line right there in ZB. That's going to be bearish if we break it. And then remember on TLT, I showed you that horizontal support, similar right here. So even if the trend line breaks, there's your benefit of the doubt line, about 177. 177.094 is where I have it. Much below that, that's going to be bearish for treasuries. However, as I like to say, support is support until unless broken. If they bounce up, that just takes us back to the top of our trading range. So that's it. There's the bigger picture. We're kind of locked in, just like the stock market, a sideways trading range. If that were to happen, that's bearish for treasury bonds, which is typically bullish for the stock market, and vice versa. However, the Fed has an extremely heavy hand in the bond markets right now, which is distorting what we call price discovery, the natural interaction between buyers and sellers. So, where this goes, the Fed has probably more of an impact than the natural financial markets. So, take everything with a grain of salt. I just want to show you the levels. But I will say this: that the machines fire off orders. The algos, as well as humans, they watch these trend lines. So if you break that, yeah, you'll probably see a quick move down to 177.094, followed by reaction, and if that goes, probably more selling is what I would suspect. All right, the other one was UB. I'll hit on that real quick. There it is. So UB, because TLT, remember, TLT is a 20 to 30 year treasury bond ETF. These are your longest term, like 20 the 25 or 27 to 30-year Treasury bond futures. And so they did have that little overreaction, overshoot right there, the trend line. Other than that, it's pretty well defined. So there's the same story. We're either cracking it, or if you want to just move it down here, catch those recent reaction lows right there, we're right on it. So there's the story here. Is the stock market is poised to break out above the 200-day moving average and that price resistance we've been in recently, the trading range. If that happens, you'll probably see this. I'm leaning towards any breakout in the stock market being limited to about 2 to 3% upside, and if so, you could have a nice whipsaw signal there. Anything much more than that, you could see treasuries come under a lot of selling pressure if the stock market can power on through, and go up much more than 2.5, 3% from where we're at right now. And of course, we could fail here. Back, I said earlier in the video, the stock market, I'd say 60, maybe 70% chance they pop the 200-day, make another run, couple percentage points. Look, as I like to say, resistance is resistance until unless taken out. So the stock market is at resistance, the S&P 500. Treasury bonds are at support. Support is support until unless broken. So we could easily do this. These are the things to watch for today. Bottom line, and I'll wrap it up here, I think we're at a very critical inflection point in the market where, the next, if it's much more than 3% to the upside, could determine whether or not this market is going to go anywhere close to get to the old highs or not, or if we're going to reverse and technicals play out. I told you I'd touch on LQD, and I didn't do that earlier. I just said I'd wrap it up. But remember, my plan on LQD was we hit the gap the other day. We backfilled the gap almost perfectly, and I said we'd probably bounce from there. And I'm looking, and I'm still planning to do this, wait for the first reaction high. Once we get a reversal, I think this will be it. I put pretty good odds. I'll even go so far to say right now, I think LQD could be a short here on a break of this trend line. We already have it as an official short, but I told you I don't have any high hopes for it because the Fed is supporting this market, corporate bond market, aggressively. But a break there, look, we backfilled the gap and we bounced back to the top of the gap. I'm talking about this gap right here. And so that is gap resistance. So you could objectively short LQD here, or wait for a break of the trend line, maybe do both. Short a half position here, half on a break, and look for another backfill of the gap. But again, it's just not enough meat on the bone. So I'm not sharing this so much as a trade idea. You can do that. You just have to leverage up because that's only another backfill of the gap would be 2.5%. So the way to trade that is bonds have much less volatility and risk than stocks. So where you might normally put in, let's say 30,000 is your number to buy an Apple or SPY, you could do 100,000 in LQD or TLT because they don't move as much, and then that makes it worth it. So yeah, you lose a little more if you're stopped out, but you're also increasing your total dollar gain potential if you get that 2.5% move. So I'll update this one later. I'll probably, like I said, I think we'll reverse here soon. Then I'll probably lower the stop down to just above that, or maybe about right here a little bit, but. If you're even still in this one, I shared my thoughts once the Fed came in to support the market. Like I said, they're not going to let this one crater, at least not anytime soon. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.